So you might have seen this viral meme on X that's been circulating the last few days. It's a ridiculous, over the top morning routine by fitness influencer Ashton Hall. Takes more than 5 hours. The original post on X has garnished more than 740 million views. Today, I want to evaluate the company behind all of this and find a trading opportunity with a better than 200% return on investment. You're going to want to stick around for this one. Hey everyone, Tom Gentile, America's Pattern Trader. And if you're a first time viewer here, I'm not a meme trader. I trade repeatable patterns on the most popular stocks that have options. Today, however, I'm going to do something a bit different. I'm going to take the biggest trend on social media that's going on right now, and I'm going to spot a trading opportunity from it. So let's talk about the latest meme to trend on social media right now. It starts with Ashton Hall's morning routine, and it quickly spread to celebrities and influencers on social media doing parodies off of it. Here's one with Piers Morgan. The video is packed with every over-the-top morning routine tip you can imagine, from removing mouth tape to working out, swimming, rubbing banana peels on your skin. But more importantly, throughout the video, what he does is he drinks and he plunges his head into iced Saratoga water. And that's the theme, because in the last few days, Google searches on Saratoga water up nearly 1,400%. That's going to have an impact on their parent company, which is a publicly traded firm, Primo Brands. That's what I'm interested in. So we could talk about all the volume that Primo's getting, or we could actually look for a repeatable pattern. And it just so happens this stock actually has one. So looking at the seasonality chart in the last 10 years, it's had bullish seasonality from March to July. Now we're talking average bullish just above 70% with an average monthly return on investment of near 4%. This gets even better. Take a look at the recent chart of Primo Brands. First, the trend is bullish. It's also well above its 200-day moving average. Day-to-day price action's positive as well. You've got that shorter-term moving average crossing above. Looks like it's about to do that right now for another bullish cross in a matter of days. This is interesting because most of the meme stocks that I trade, I tend to fade the crowd. That means I go the opposite of what they're doing. That's because they don't have rules-based trading like I do. This one, however, I actually like. So let's say you like the pattern. The next question you need to be asking is, how do you trade it? So let's talk about 3 different strategies with this stock potentially moving 20% between now and July. The first one would be simply to buy the stock right now and sell it in July. Right now, Primo's trading around $34 a share. If you buy 100 shares of Primo, it's going to cost you $34 times 100, $3,400. Now, assuming a 20% target, that's going to put the stock at about $40.80, which gives you a profit of $6.80 per share. Another way would be to buy a call option. This gives you the right to buy the stock. Most option traders, they end up flipping the option. They hope to flip it for higher than they bought it for by expiration. Right now, the PRMB July 18th 35 calls, they're priced for $2.50 each. That's $250 a contract. A contract is good for 100 shares of stock. That's your cost and risk on the trade. To get the break even on the trade, you need to be strike price plus premium. That puts this around $37.50 by expiration. Now, if Primo were to go to the $40.80 target that we were looking at in the stock by expiration, the option would have a minimum value of $5.80. That gives you a $330 profit on risk of $250. That's 125%, folks. Question I always ask myself is, can we do better? Let's build a call spread. That's where we buy a lower strike call and sell a higher strike call. Now, using the same 35 call we bought, let's keep that, but let's also sell a July 18th 40 call. That's going to help bring in premium to offset the cost of the 35. Now, as you can see here, the 35-40 call spread is going to cost just $160. That lowers your cost, that lowers your risk, and it lowers it by almost 40%. Your break even is also going to go lower as well by about 90 cents. Now all you need is $36.60 to get the break even by expiration. And last, but definitely not least, if this stock is above 40 by expiration, your return on investment will be 212%. That number, we get that from taking the max profit of 240 and dividing it into the spread cost of just $160 per contract. Now, before we do the comparisons on everything, if you think this video has been worth your time, do me a favor right now. Like, share, subscribe. And also, if you want my next 3 seasonal picks, I'm doing a live webinar on Thursday, March 27th at 2 p.m. The links are below, so come and join me. All right, on to the final comparison. First off, you never get 100% on one strategy, but in this case, the majority points to the spread. Take a look. Cost and risk, reward, and ROI all go to the spread, as you can see. Only break even is best when it comes to the stock positions only. And what about the calls? Well, they scored nothing on my spreadsheet. They didn't have the best cost, they didn't have the best risk, they didn't have the best reward, didn't have the best ROI, and they didn't have the best break even. And that's interesting considering that meme traders typically buy call options. Maybe that's why they lose so much money to guys like us. All right. Hope you enjoyed the video. See you on the next one.